Hi everyone, it's Chat about another video, and today I'm going to be talking about ASML. It's a company I've talked about many times and that I really love to talk about and analyse. It's just released its third quarter earnings and has actually got a decent response from the market, up 6%, which is not what was expected, I think, and on a broadly down day, so I think we could expect that we would have seen a greater than 10% rise otherwise. It's still quite near its 52-week lows of $363, sitting at $420 right now. Lost about 50% on the year, 47% down year to date. That's terrible performance, obviously, but this is a fantastic business that continually returns capital to shareholders, has an earned monopoly in the EUV space, is absolutely critical to the world economy, and I believe it's trading at not unrealistic valuations right now. So let's talk about the results, talk about their outlook going forward, how they're doing on their plan, and then talk about valuation, do a DCF, see if I think this is a buy, sell or a hold right now. Appreciate it if you like and subscribe to the videos, if you enjoy the content. Let's get into it. First of all, a summary of the results. Net sales of 5.8 billion euros, net system sales of 4.3 billion, and installed base management sales of 1.5 billion euros. The 5.8 billion euros was quite a clear beat versus a 5.4 billion euro forecast, and this has really bucked the trend of the semiconductor industry. We were supposed to be seeing a secular slowdown, and ASML is just not seeing this, and it's clearly not seeing the impact of the US limits to exports to China. Gross margin at 51.8%. This is slightly lower than the long-term average, but is perfectly fine. Operating margin 33.5% is absolutely excellent. They're converting that gross margin really, really well and speaks to the strength of this management team. Net income as a percentage of net sales, 29%. Outstanding. Earnings per share of €4.29. Not incredible by any means. They actually were down 2.2% year over year on a net profit basis. However, versus the quarter prior, they increased. So it's not the end of the world, but the revenue numbers really to speak here, because they have been facing a lot of pressures, margin pressures to do with their supply chain. Record quarterly net bookings of 8.9 billion euros, and generally this is just a really strong quarter versus the broad expectation that there's going to be a slowdown in this industry, and ASML is surprised and bucked the trend. Net system sales is the most important for this company. System sales outweigh the install base management on a 3-to-1 ratio, so while both are important, this is really the chain move for this company. On a year-over-year basis, they recorded about $100 million extra, or 100 million euros extra sales, and that is primarily EUV pushing up. A lot more going to Taiwan, 6% more going to Taiwan, and that's Taiwan Semi, basically. The lithography units, roughly the same spread year over year, slightly more EUV, which is a trend we're going to continue seeing as they expect their sales to be made up of around 60 to 70% EUV in a few years. The memory weighting versus logic increased slightly, but logic still far outweighs it. Overall, the key thing here is the China weighting, that 10% last year, 15% this year. We're not really seeing the slowdown that was expected on the import side of things. They saw a slight decrease in sales to Samsung, as you can see, 33% last year and 24% this year, but that's more than made up for by the increase in Taiwan and the increase in the rest of the world. The outlook again was much rosier than expected. Net sales between 6.1 billion and 6.6 billion euros, and install base management sales around 1.6 billion. Now, this is obviously a very wide range, but it's again broadly in line with what was expected of this company, and it's going to put this company around 10 or 15% up for the year. Net delayed revenue recognition of around 0.1 billion, so not really anything to shout about due to the faster shipments. Expecting gross margin for Q4 to be around 49%, which is a slight decrease on this year, so we might see the earnings per share come a bit later again. But again, in the medium to long term, this is absolutely no concern. R&D costs are about where they normally are, if not slightly above. For the full year, they're expecting sales to be around $21.1 billion at the midpoint of the guidance, with a gross margin of 50% average across the whole year. And this is about a 10 or 15% increase over the last year, which is decent considering the drop in valuation this company has experienced and the supply chain challenges it's experienced. This is a graphic that the management display in every IR presentation, every quarterly earnings presentation, and it's basically the investment case for this company. And one of the key messages here is that they predict for the whole 2020 to 2030 period, they predict an annual revenue growth rate of around 11%, and they think this is going to happen with some certainty. They are expecting in 2025 to be an annual revenue between $24 billion and $30 billion, with a gross margin between 54 and 56%. So they've got some work to do on that 54 and 56%, because we're well, we're expecting to be at 49 for the next quarter, but of course there are a lot of supply chain challenges and a lot of clamp down on this industry and inflation problems that is biting hard on the margin. Nevertheless, they're expecting to do this. They want to continue to return significant amounts of capital to shareholders through cash and growing dividends. Dividends have grown an extreme amount over the last 5 or 10 years, and share buybacks have been plentiful. Overall, I think this is completely possible. They have so many global megatrends behind them. They've got an monopoly in the EUV space, and no one is really approaching them. I think this is one of the hardest companies to disrupt, if not the hardest in the world, possibly with Taiwan Semi as well. And just the general growth in semiconductor end markets will push this company to around 10 or 11% growth rate for the next several years, in my opinion, at least. ASML's revenues grew at a compound annual growth rate of around 14% over the last 10 years. They have gross margins over 50% and an earned monopoly, and return a lot of capital to shareholders. Of course, this company is going to trade at premium to the S&P 500. Right now, its PE ratio is around 30, on a forward basis 22. These are both a decent amount above the S&P 500, a decent premium. That being said, it has a PEG ratio right now of only 1.17. That's almost bargain territory. Has a price to free cash flow of just under 19, which is kind of in a reasonable territory. I'm quite happy to pay under 20 free cash flow for quality businesses, and I believe this is an absolutely premium business. It returns a lot of capital to shareholders. It's consistently profitable, and it is riding one of the biggest global megatrends and looks pretty much indestructible for my money. After looking at some basic valuation metrics, the next logical step is to do a DCF to work out a fair valuation for this business based on the sum of its future cash flows. Over the last 10 years, it has grew its free cash flow at a compound annual growth rate of 22.6%, which is absolutely outstanding and unlikely to continue in the distant future, in my opinion. For this company to be fair valuation right now, it needs, with a 9% discount rate for the long-term returns of the stock market, it needs to average a free cash flow growth rate around 8% for the next 10 years. I think this is absolutely possible. They have spoken in their own literature about wanting to increase revenue at 11%. If free cash flow just grows in line with revenue, which is very likely to do, then this would be very achievable, and they would smash this target, and they will be far below the fair value right now. Revenues grew at 14.4% on average for the last 10 years, 21% over the last 5 years, 19% over the last year. I think this is a company that can absolutely achieve these goals. I think this is a very, very conservative scenario, if not kind of base case, because I believe this, without massive changes to the world economy, the growth in semiconductors is almost likely, it's almost inevitable to happen at an 8 to 10% compound annual growth rate, and this company can quite easily ride that wave. Overall, the short to medium term challenges that this company was expecting to face, it seems to be riding them out quite well. The export pressures it's feeling with the USA wanting it to stop exporting to China, it's not really feeling the pain of that right now. The global semiconductor slowdown that many companies like AMD, Intel, Nvidia are feeling, ASML seems to not be feeling them whatsoever, and it's just continuing to chug along. It's feeling a reduced growth rate. It's been in the 20-30% range over the last 5 years. It's dropped down to 10 or 15%, and it's lost a couple of points of gross margin. In the long term, does this really matter? Not at all. I think this is a rare opportunity to pick up this company at a PE ratio of like 22, and looking at it trading below its fair valuation. This doesn't happen very often for this company because it has traded at such a premium for such a long time, because while it's not the most well-known company in the world, to those in the stock market, this is a well-known company, and it trades at a premium for a reason, because it has 50% gross margins, is nigh on indestructible because of it's such a strong monopoly, and it is absolutely necessary to the global economy moving forward, and will continue to grow at 10% compound annual growth rates for several years, in my opinion. I think this is an absolute steal right now at 22 times, and I'm going to keep on adding to my position until it probably becomes my largest position. That's not even to mention the capital returns that this company will experience and the dividend yield, which is fast growing and now at 1.75%. I'm quite happy to lock in that dividend yield above the S&P 500 average. Of course, none of this is financial advice. You should let me know in the comments below what you think of ASML. Don't just do anything because I'm telling you, because I'm not a financial advisor. You should do your own research and due diligence. Let me know what you think. Let me know if you think this is a pig of an investment. Let you know if you think this is the time to buy. Like and subscribe if you enjoyed the video. I'll see you again next time.